Let's take a closer look at where markets and rates are going right now. Chartmaster Carter Worth is with us. So, Carter, what do you see?
Well, I think the first thing, what a tough game. Humbling for all of us, always trying to be as good or bad as our last trade. But let's look at the charts and figure it out together. I have a long-term chart of the S&P, and you'll see the annotations there. That's the 2007 peak. We have the financial crisis low. And if you were to accept that channel, and it is the channel that the market ascended in from the '09 low, we blew out through the top ever so slightly, and now we're basically back at the midpoint. And the question remains, do we ultimately have to get to the lower band? And that lower band is numbers that you all have just discussed, that 3,200 plus or minus level. And even if you don't go that low, do we even get into the lower band? And I think yes. So lower remains the thinking, at least from this seat. Let's go a little closer, a little more here and now. So there is the past 2-3 years, and what is quite remarkable, and at least happy for those who can draw a straight line, so to speak, the market has adhered to these lines. Put in some arrows, and you'll see just how well in this next iteration, the market on the way up and the way down literally has responded to the penny to those trend lines, and it has failed dramatically yet again in the past 3 to 5 sessions. So the here and now chart, the really up close and personal chart of the S&P, the question is, and you'll see that here, do we fill the unfilled gap at 38.18 from November 10? And that's only about 1 to 2% lower, and I think that's a foregone conclusion. But you'll see that sort of minor triple top, you'll see the break-in trend, and to my eye, it's if you can use the word inevitable, and you shouldn't, or you can't, it's inevitable that we will get to that gap, 3.818 as a minimum. In terms of yields, I think I have 2 yield charts here if you want to take a crack at that. This is the 10-year yield with no drawings, no judgments, no lines. Let's put some in. And what you'll see here is that here too, respecting trends, minding one's lines is important, that we bounced off that trend line beautifully. And then once you undercut, which has happened, you want to be on the other side of things. I'm in the lower yields camp, and again, lower dollar camp, and that stocks ultimately, and they are, right, going to resume their downtrend that's been in effect since Jan 4.
3818, Carter, the level in the S&P 500, you say we will hit. That, though, is just a stop in a longer-term downtrend, correct?
I think that has to be the conclusion. Or said differently, we know that trends are characterized by counter-trend moves. When you're advancing, you have sell-offs. When you're declining, we've been declining since Jan 4, we've had counter-trend moves, rallies. And is this anything other than that? We rallied from the June 16th low to the August 16th high, failed. And then we had the October 13th low. We rallied again until we started failing 3 to 5 sessions ago. And as of now, it can only be characterized, what we saw October 13 to the peak of 3 days ago, as a counter trend rally.
All right. Carter, thanks. Good to see you. Carter Braxton Worth of Worth Charting. Steve Grasso, a move down to 3818 is basically, on a percentage basis, a move like we saw today.
Yeah, I'm looking at a chart, and you see first of all, the 3,300 was the level that stuck out to me, that would around the pandemic levels, pre-pandemic levels. We didn't get that far. That was the level I was calling for. So now when I look at this chart, we have stutter steps at 3,500 and 3,200. So if you draw your retracements from the pandemic low to the all-time high, those levels of 3,200 are probably in the cards, but when?
Yeah, I'd just say they're probably in the card. That's the technicals. The fundamentals speak to something different, right? So all these headwinds to earnings growth are the thing, right? And so when we finally have companies taking down their guidance, analysts, downgrading their guidance, strategists bringing down the top-down guidance, that's the thing that probably causes those levels to be violated. And again, it's not like, being doom and gloom or anything like that. It's just kind of putting all these pieces of the puzzle together. And we really haven't had, take out the pandemic and the recession that we had there. We haven't had this sort of cycle to deal with. So again, you know, the S&P making a reversal on one of those counter trends that Carter just called it is not going to be the end of this thing, because there's no easy fix for the economy in the near term, because we haven't had the absolute effects of all those rate hikes. I know that sounds really redundant, but the market has a bit of a conundrum, only down 18% from its all-time highs.
I don't want to be doom and gloom, but I'm going to throw this thought out there, and that is that we might not even see the full effects. I mean, we're not going to see it. We'll see it on a rolling basis, right? I mean, the lag effect or the lag effects. You might see the effect of 75 basis points on consumer spending. You'll gradually see it work its way through. There is no bell that is going to be rung when companies have reset their earnings expectations and are done with it.
Yeah.
I think that's one of the things that the market has to grapple with at this point. With the rates remaining higher for longer, those effects are going to be residual and continuous, Karen.
They will, but I think we'll also see, as things sort of work their way through, we will see inflation come down.
Right.
When do we get to that positive interest rates? I don't know. We're far, far, far away from that right now.